Good morning, everyone. My name is Dr. Uma Maheshwari. I am going to handle the course Risk and Uncertainty. Risk and uncertainty is one and one interdependent. It is displayed in the form of the picture. So, risk defined. Risk refers to the set of unique outcomes for a given event which can be assigned probabilities. Risk exists when the decision maker is in a position to assign probabilities to various outcomes. That is, a probability distribution is known to him. This happens when he has some historical data on the basis of which he assigns probability to other projects of the same nature. Uncertainty defined. Uncertainty refers to the outcomes of a given event which are too unsure to be assigned probabilities. Uncertainty exists when the decision maker has no historical data from which to develop a probability distribution and must make intelligent guesses in order to develop a subjective probability distribution. Risk and uncertainty. Risk. Possible outcomes are known as their probabilities of occurring tangible and quantified. In uncertainty, outcomes are probabilities are either unknown or estimated with low precision. Risk reward returns. Greater the risk, greater the return. A risk without return is a suicide. Risk can be minimized but cannot be eliminated. Risk can be managed to keep it at lower side. There are two types of risk. One is systematic risk, the other one is unsystematic risk. Systematic risk is nothing but market risk, interest rate risk, purchasing risk. Unsystematic risk is nothing but business risk, financial risk. Systematic risk. So, systematic risk is nothing but market risk. Market risk is the risk that the value of an investment will decrease due to movements in market factors. The reason for such uncertainty is market forces represented in two markets, that is bull market and bear market. Interest rate risk. Interest or rate risk is the possibility of an unexpected change in interest rates prevailing in the market, which affects the value of an investment adversely. Generally, the value of debt instruments like bonds, debentures, commercial paper, etc., is directly affected by interest rate risk. Purchasing power risk. Purchasing power risk is a possible reduction in the purchasing power of the expected returns due to the high rate of inflation. There is erosion in the purchasing power of money which results in increase in returns. Unsystematic risk. Unsystematic risk may be specialization to an industry or a company and at cost due to deficiencies in one or more of the following. Number one, lack of managerial ability. Number two, technological advancement in the process of production, procurement of raw materials, lack of human resource, change in consumer preference. Unsystematic risk. So, market risk is a part of the unsystematic risk, which basically comes from the operational activities of the business due to certain inbuilt deficiency in the operations of the business, due to certain risk also. Internal business risk. Internal risk is related to with the operational effectiveness of a company. The operational effectiveness of a company is measured in terms of the level of its targeted achievements and keeping the promises made to its investors. Number one, sales variation. Number two, R&D, research and development, personnel management, fixed cost, single product. Unsystematic risk. External business risks are the risks caused by the circumstances which are external to a company business. The company has no control over these circumstances or factors. Social and regulatory factors, example, telecommunication, that is government traffic policies. Similarly, the profitability of banks is affected by some of the regulatory directions issued on the lending policies. Political risk. Frequent changes in the government and its policies have a negative impact on the business environment. Business cycle. Boom and recession is the best example business cycle. Textile industry will be in the boom for short period. After that, the demand will decrease. Financial risk. Financial risk is a function of financial leverage, which is the use of debt in the capital structure. The presence of debt in the capital structure creates fixed payments in the form of interest, which is a compulsory payment to be made whether the company makes profits or losses. This fixed interest payment creates more variability in the earnings per share available in equity shareholders. Financial risk, credit risk, currency risk, country risk, economic risk, liquidity risk. Thank you.